Hi, welcome to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. My name is John Mark Young. I'm the President and Chief Investment Officer of Whitaker-Myers Wealth Managers. Remember, our aim with these videos is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets while also drowning out the agenda of the news media in America. So let's talk about the 4 things we learned in the markets this week. The first thing is, it feels kind of like old hat here, but here we go again. Another week of volatile market movements. The VIX is well over 30, which basically means it expects 2% moves every single day, including Thursday, where we saw a bad inflation data to start the day. That was presented, and the market started the day down about 2.5 and ended the day up about 2.5. Today, Friday, October 14th, the Dow Industrial fell 403 points. The S&P shed 2.37%, and the NASDAQ ended the day by falling 3.08 for the week. The Dow came out with a small gain for the week, 1.15, but unfortunately the S&P 500 fell 1.5%, and the tech-heavy, your more growth funds, NASDAQ dropped about 3.11% for the week. Point number 2, Thursday's CPI data, which told us how inflation reacted in the month of September, came in hotter than expected in both the headline number, which came in at 8.2%, and they were expecting about 8.1%, and core inflation came in at 6.6% versus about 6.5% was the expectation. This again feels like old hat because inflation has been coming in hotter than expected nearly every month this year. However, what made this week's number so important was the number for core CPI, which means kind of the sticky inflation. It's more ingrained in our everyday lives when it hits core, and that hit a fresh high. The only time in history that the core number was constantly above 6 was during 1974 through 1982, which was another economic period of time marked by high inflation. Point number 3, not only is the U.S. inflation still running hot, but companies in aggregate are not yet reducing their workforces. Yes, there's some layoffs here and there, but however, the initial unemployment claims for unemployment insurance remained low by historical standards. Last week, only showed about 228,000 new claims. This is almost the same as they were in 2019 when the economy was clicking on all cylinders under President Trump. Workers are just finding new jobs quickly when they lose their job, and that is not surprising given the JOLTS data we get, which shows that companies remain eager to hire. This is a problem for the Fed because the Fed is they're trying to kill the U.S. labor market right now, trying to push unemployment rates higher to reduce high wage inflation. Not only must Thursday's CPI report been terribly disappointing to Fed President Powell, but the initial claims data says their efforts to slow down the labor markets in America are just not proving to be effective. And finally, point number 4, let's talk about third quarter earnings, which started this week today and will continue for the next month or so. Analysts are looking for $55 a share in S&P companies' earnings from the third quarter of this year, again, to be reported over the next month. According to DataTrek, a research firm led by former SC Capital analysts Nick Colas and Jessica Robbie, this is a reasonable estimate because it's actually about 3% lower than quarter 2 earnings. And remember, what I discussed last week, the Atlanta Fed's GDP Now model says our economy actually grew in the third quarter. And we'll find that out later this month. Therefore, $55 a share annualizes into $220 a share. That puts the S&P 500 at a 16 times multiple on earnings, which is a pretty fair number. Not expensive, but not cheap either, based on historical standards. In 2014 through 2019, we ran anywhere between 15 times and 19 times earnings. And the markets are just pricing in recession fears right now, which the Wall Street Journal just announced this last week. Half the economists now believe we're going into a recession next year. So let's assume we have a mild one. You have a 10% drop in earnings from their current levels. With the S&P now trading at about 3,600, that puts us at an 18 times multiple if we get that reduction in earnings. We think that's a fair valuation, assuming that the recession isn't deep, which is something we have to assume, and we get a quick return to higher earnings post-recession. Additionally, the market needs clarity on the Fed funds future rate policy. Now, next week, I'll walk you through what the current Fed funds future rates, which is the expected rates we think, or the market, not we, but the market thinks the Fed is going to take us to over the next month, 2 months, and into 2023. And that number, to tease it a little bit, it keeps going higher and higher. We keep assuming that the market keeps assuming that rates are going to be at X, and we keep having to push that up for many reasons, not the least of which is inflation and labor data that we keep getting on a monthly basis. So if you have any questions about the 4 things we learned in the markets this week and how it might be impacting you and your personal situation, you can go to the notes where you'll see a link to go to our scheduling software, and you can schedule a meeting with any of our advisors that you'd like to meet with, or you can go to our blog section, which is also in the notes, and there you can read about what we're thinking about right now from a financial planning perspective or a market perspective as well. Thanks so much. We look forward to talking to you soon.